Hello, my name's Terry Hess. As a podiatrist since 1993, I've always wanted to help our patients. The last 5 years or so, I've wanted to help us, the podiatrist, to make it better since these times are changing so rapidly, and now with COVID, even more rapidly. So my plan is to try to reach out and help all of us that I can to make it better, especially on the other side of what's coming our way, because I really think we have an opportunity to do a better job than we've ever done through telemedicine and just forward thinking.
Going back into here, I thought if you end up really wanting to look at a bit in some detail as well, I thought this is a good site that can help you out with some of those examples. I put an example right here, right, so that you could figure out how to get to your loan amount. But when it comes to the forgiveness, I thought this site did a good job with that. So I would really recommend that. So if you all have any further questions, this was just a really quick rundown, but if you all have any other questions, feel free to ask afterwards.
I got a question for Brian. He talked about one of the requirements for the payroll protection was a transcript of payroll taxes. I just have one office. It's just a few employees. We use QuickBooks, and I'm not sure it has that. But my question is, and I did some reading. I was under the assumption that you could also use last year's average monthly payroll. Why couldn't you just take your W-3 that shows what your payroll was for the whole year of 2019 and use that and divide it by 12 to get your average monthly? Or am I missing something?
Yeah, so what would occur under that scenario? So let's say you did that. Let's say you took your W-3, right? And then you just divided it by 12. And when it comes to the whole 12-month thing, that's one of the areas that I don't think there's very good guidance, right? If I remember correctly, the actual terminology is 12 months prior to loan origination, right? So theoretically, that would mean sometime in April of last year through sometime of March or April of this year, right? But I've heard the same thing too, where, well, there's another document that just says the word last year. And this is also another government document, right? That just says the word last year. So do you mean literally the last calendar year of 2019 or the last 12 months? So that's one of those areas where I've not found the perfect, especially because I've read two different government documents that kind of contradict each other. So I'm just doing the 12 months prior because I feel safe under that scenario. But take 2019 if you feel best. But let's say you did take 2019 and you took that W-3. Well, if someone made over $100,000, you have to subtract them. You have to take out anything over $100,000. So make sure you do that. Then the other thing to keep in mind is that your W-3 isn't including the health insurance that you've paid, the retirement benefits that you've paid, the SUTA that you've paid, and you have to add all that back to your payroll, because that's part of payroll. So the government says that we can add all these things. So when it comes to using QuickBooks for your payroll service, right? So asking a question to you, who actually does the government filing for you? That does your payroll taxes and all that stuff?
I do it myself.
Perfect. So then the 940 and the 941, those documents, correct?
Yes.
Perfect. So then those documents plus any, so we don't do any of that. It's actually one of the things I really love. I don't have to do any government filing here, right? We pay someone to do all that for us. But back in my previous life at my last job, so I was a CFO in the state of Florida, and for a while, I handled all the payroll taxes, myself and my team, right? So we also had to turn in a state unemployment tax in the state of Florida. So if you have to do that here, which I'm guessing you do,
yes,
that document, you do it by quarters, right? So you have that. So then just total up all the amount of SUTA that you paid during those 4 quarters, and bam, now you have your SUTA amount that you're gonna add to your payroll. So that's one of your numbers. But then don't forget that health insurance, right? Because if you're paying $200 per employee per month in health insurance, that's $2,400 a year plus however many employees that you have, then now you can add that to your payroll as well, to your payroll cost total. So definitely don't forget that. And if you're doing any 401k matches, don't forget that either. So the W-3 is a good start, but it's not everything. You need more.
But would you recommend sending that W-3 at least in, or that documentation in as an attachment, or do you just wait and see what your particular bank wants in terms of any documentation, I guess is what it would boil down to?
No, sadly, the W-3 is not going to count. And the reason is the government has asked for one document that we know. We know for certain the government's going to want this one document. It's payroll register, right? It's not W-3. They have the W-3 already. They can pull the W-3 anytime they want, right? We filed it in with them, so they have our W-3. No, what they want is an actual payroll register. And why? Why would they want a payroll register, right? So what a payroll register is going to do, it's going to tell you who's made over $100,000. So the government's going to know, have they removed all the people that made over $100,000? The payroll register is going to tell you that, right? So what I did, just to, Jared, you said you have ADP. So what I did is I ran the combo bill for all of 2019 and then also for the first quarter of 2020. So I have everything the government's going to possibly ask of me. And this combo bill is going to have all the data that I need, including my health insurance, my student, everything like that. When it comes to QuickBooks, it should be in your QuickBooks file as well. It should be in there because obviously you have to have your costing in there, right? You have to know how much money you're paying and all those things. So would it break down that payroll register? Would it be like for the whole year, or would it be would it do it by month? Because I know when I click on payroll register, it brings up everything or something equivalent. It brings everything up. I mean, it goes on for pages and pages of each deduction and all that. Is that what you're talking about? Yeah, so it's very similar to that, yes. So what you're going to do is you're going to do a date range, right? So this is going to be the fun piece. I personally think give them more information, right? If you're giving them all the detail, right? So mine isn't quite like that. So as an example, we get paid twice monthly, right? On the 10th and the 25th. So each month, each person has 4 different line items, basically one for each of the weeks. So that means, over the course of a year, someone's going to have 48 line items. Yours is going to be so much more detailed because QuickBooks really does break it down even more detailed. Mine, everything is on one row. So it's nice and easy, and then it has all the different columns that I need. Yours is going to be a little bit more intense. But if say I was your CFO, right? Let's say I was sitting in that position. I would probably want to grab more detail and then let the government figure it out from there, because everything's going to be there. What's going to be important is that I can calculate it based off of that information. So if I can sum my gross wages, right, because that's what you're going to want. You want your gross wages. And I have somewhere that tells me how much is SUDA and how much is health insurance. If it has all those pieces, I'm okay. If it gives you more than that, who cares, right? Like my information I'll give to the government is going to be so much more too. I'll let them figure that out. Okay. And I'm imagining there is a very low audit risk. Not saying, certainly be aware that you could be audited. So I certainly don't want to say that there's no risk, but there seems to be a very low risk in an audit. That's
okay,
possible.
Thank you.
You're welcome.
So Brian, I have a question. So if you take out this loan and you use it on payroll and utilities and rent or interest on your mortgage, and you still have, number one, how do you report how you're using that money so that they know that you're using it? And number two, what happens if you still have money left over in the loan afterwards? Do you start paying interest on that, or do you just pay it back? Like what's kind of the deal at the end here?
So those are great questions right there. So when it comes to right? How do you show your proof? Canceled checks, that's one of them, right? You got your canceled checks. So this is what we're going to do. So I'll just tell you how FASA is going to do it. Terry, bless his heart, spent 2 hours at Wells Fargo today opening up a bank account, right? So what we're doing is we're going to open up a separate bank account that the money's going to go into. Then we're going to pay all of our expenses off of that bank account. Nice and clean, nice and easy, right? It's not being mixed in with anything else. I say, here, government, here's my proof. It's all there. The amount that I am asking for loan forgiveness matches the amount that went out of my bank account. So that's my personal recommendation. But even on top of that, what the government has mentioned, you have your canceled checks, you have your bank statements that show it. So you have lots of documentation proving that you've paid it. And don't forget, this is going to be treated as a cash method. I'm guessing everyone here is cash method, so you're probably okay, not accrual. So that means if you're using your credit card to pay for anything, you have to have paid for your credit card already, okay? So if you paid it on your credit card and your credit card isn't due until after the loan forgiveness time frame, you're not gonna get loan forgiveness for that. So keep in mind, this is all cash basis. So when it comes to, so let's say you got $250,000, right? That was your loan. And let's say you managed to get $200,000 forgiven. So now you have $50,000 left over that you're gonna have to pay. So the interest rate is going to be 0.5%. Your first payment is going to be deferred for 6 months after you get your actual money. So let's say you get your money May 1st. Your first payment isn't due until November 1st. Before November 1st, you would have already had your $200,000 forgiven. So that means now you have $50,000. Keep in mind, the 6 month is a deferral of payment, not a deferral of interest. Your interest has been accruing in that time frame, and now 6 months later, you're gonna be hit by that interest. But that's 0.5%, so it's not something to worry about, right? 0.5%, you're never gonna get interest that low. But on November 1st, you have to start paying that $50,000, and you have 2 years after that to pay it at 0.5% interest rate.
Thanks for watching. This is so important right now. We'd love to help, so please reach out to my CEO, Jolene, at jolene@anklefoot.net, and we'll do our best to reach back to help you guys through this crazy, crazy time. Thanks.